as of today, has annualized, or well, excuse me, in 6 months, 2 quarters, has gotten me over 100% return. And if you compare that to any of the market indexes, it crushes any of them on Wall Street. So we're here today to talk a little bit about how Glen strategies can be applied to anyone in any situation with the skills you currently have. And so I'll let Glen take it away and talk a little bit more in depth about what it exactly is that he does.
Sweet. Plug the mic in. Made some slides in about 25 minutes. I've been writing for TheStreet.com. Started my own hedge fund this summer, running millions of dollars in the stock market, doing really well. And I figured that one way to give back to Purdue would be to pass on some basic ideas that they really won't teach you here because they just don't. And financial education is something that I think Americans lack in general because there really is no opportunity to get one unless you go out and get it yourself. This is a book that I'd recommend. It's a little book that beats the market. Within this book, this guy developed a strategy that pretty much crunches numbers, and he used it to annualize 40% over a long time horizon. So, time does not equal money. I'm doing this because educational systems hardwire us to work really hard for money, and I just don't think that's necessary. I can't help you if you can't help yourself. It's like, I could point you to a big pile of money, and if you just can't go and get it, I'm not gonna go and get it for you. And this is more about me empowering your success than me just helping people out, because I realize I can't help out everyone, and I realize not everyone wants my help, and I realize that it's not worth my time to help out everyone. But this is just something that I want to do because I think it's fun. For me, this is like heroin. Once you taste it, you never look at things the same again. Like, I was making more trading my own college tuition in the stock market than I was as an engineer last year. And the feeling of being able to do that, I'm just not interested in working a job anymore because, if I can do that with just a little bit of money, imagine what I've been able to do with a lot of money. And financial advice, as far as, I've met a couple pre-financial advisors in school, and I thought it was very interesting because, I'd ask them their opinion on the market, sometime over this last year, and, they didn't really know, or, a 4.0 econ major, they didn't know what the market was doing either. And I've been to various MBA competitions, case competitions. It's good to know that around the country, they all kind of teach the similar way of viewing how the market works, and that is the efficient market hypothesis. And I learned in engineering how to prove hypotheses and disprove them. You basically have a antithesis, I believe is what it's called. We'll just do not efficient, something like that. And basically, if you have one counterexample that proves it wrong, you stop talking about it. So I'm not going to talk about it anymore. The bottom line is choose your decimal point. Some people, I'll draw it here. Some people will choose to argue that when their decimal point is here. Some people will choose to argue when it's here. Some people will choose here. And the bottom line is when it's your money, I like to choose that decimal point as far as where I begin to argue. Like, some people will fight over cents. Some people will fight over $10,000. The further you can push back that decimal point, the more money you can make in the long run, and then you don't have to worry about the daily headaches of feeding yourself. An example of this is, how many jobs did you guys apply for this last summer? You didn't apply for any. Mazen got more job offers than he applied for jobs.
Sure.
Ben?
I don't know,
6? 1? So your guys' decimal point was about here. My decimal point was here. I applied for over 800, and I didn't get any. So I started a hedge fund. Can you see what I see? You might want to zoom in on some of those numbers. Some would see an account worth, $1.5 million. I don't see that. I see an account where in the future, sometime worth over $10 million. And I'm going to try to teach you the skills to see what I see in an account such as this. This is one that I'm managing.
What was that screenshot today?
Friday.
Friday.
There's just one. All right. You guys know of any stocks? Anything? Like Google, Microsoft, Apple? Abbott? I'll bring these next time. Do you think it'll go up or down, or do you know?
I think it'll go up in the long term.
Up in the long term. Any other ones you want me to look up, you guys? I would name better ones, but I already showed a list. Conoco?
AIG.
Actually, that one will probably do better. I have call options on AIG that I bought somewhere around March. Right. The goal of this class, as I said earlier, the goal of this class is to give you the mental framework that no MBA school will give you. A mental framework that will consistently keep you from losing money in the stock market over long periods of time. Now, in MBA school, they have this neat thing called, I don't know where it goes, this is reward, this is risk, and then there's some line, and they teach you that you need to take larger risks to take larger rewards. That's simply not true. In the last year, I found companies that are trading less than cash minus total liabilities, meaning that you can buy the company, take the cash, pay the liabilities, and be left over and have cash and assets left over after you liquidate them. I would call that an arbitrage play, but there's lots of other opportunities out there. So the real way to make money in the market is to put your money where other money is headed before it gets there. And ask me about MBA schools and incentives. The golden assumption. This is the bottom line that drives all my decisions. Companies that make more money and are set to make more money than other companies should come with a higher price than other companies. So if A makes more than B and A is growing faster than B, then A should be more expensive than B. I don't believe that stock price covariance or volatility is an indicator of risk. I think that there are situations where your volatility looks like that and it's very volatile. But those are the ones that I try to get, and I'd say that type of volatility is less risky for me as an investor than if it was going down. So what do you need if you're interested in attending this? Your brain, hopefully a laptop, because hopefully we can get some interaction as far as looking up your own ideas, troubleshooting ideas, seeing if these stocks are good or bad. I mean, AIG I'm familiar with. These two I'm not. I've been focusing more on the small cap industry lately because there's stocks out there where most people would brag about 100% returns. I mean, I've already got 10 baggers in the last year, and it's all about your decimal point. I just move one over. And that's what I try to shoot for. And aim big and limit your downside. When a company is making more money in the last year than it's currently priced at, and it's growing, and it's set to make more money in the next year,